January 22, 2018, an emergency board meeting in Dubai turned into a courtroom drama that would shake the very foundations of private equity in the Middle East. In a single, breath-stopping moment, the Abraaj Group, once hailed as the region's most ambitious investment powerhouse, faced accusations that it had siphoned millions from the very charitable funds it was entrusted to manage. Founded in 2002 by Abraaj Group, Abraaj grew from a modest venture capital boutique into a behemoth that boasted $14 billion in assets under management, a presence in 34 countries, and a reputation for funneling capital into health, education, and infrastructure projects across emerging markets. Its rapid ascent was built on a promise to bridge the gap between wealthy Gulf investors and the development needs of the global South. The firm's flagship vehicle, the Abraaj Growth Fund, attracted sovereign wealth funds, pension plans, and philanthropic foundations eager to make a measurable impact. But behind the glossy press releases lay a complex web of cross-border transactions, opaque accounting practices, and an aggressive growth strategy that often stretched the limits of regulatory oversight. In early 2018, a whistleblower, a senior finance executive within the firm, alerted the United Nations Development Program, UNDP, that the $1 billion Africa Infrastructure Fund, a fund managed by Abraaj on behalf of the UN, was missing cash. The alert set off a chain reaction. Auditors were called in, regulators in the UAE and the United Kingdom opened investigations, and the media began to piece together a story that would soon dominate headlines worldwide. The key facts that emerged from the forensic audits painted a troubling picture. First, the firm had transferred roughly $300 million from the UNDP-backed fund into a series of offshore entities controlled by Abraaj's top executives. Second, the capital calls, payments that limited partners were supposed to make to fund new investments, had been artificially inflated, creating the illusion of robust inflows while the cash was being redirected elsewhere. Third, the firm's internal controls were found to be either inadequate or deliberately circumvented, allowing senior managers to approve transactions without proper documentation or board oversight. These revelations prompted the United Arab Emirates Securities and Commodities Authority to freeze Abraaj's assets and to bar the firm from operating in the country. Simultaneously, the Cayman Islands courts, where many of Abraaj's funds were domiciled, appointed a provisional liquidator to protect the interests of creditors and investors. The legal battle quickly escalated to multiple jurisdictions. The United Kingdom's High Court, the United States District Courts, and the Dubai International Financial Center's Arbitration Center all became stages for competing claims and counterclaims. At the heart of the trial was the question of intent. Prosecutors in Dubai alleged that Abraaj Group and several top executives engaged in a deliberate scheme to misappropriate charitable and investor capital for personal gain, pointing to email exchanges, bank statements, and testimonies from former employees. Defense lawyers countered that the financial shortfalls were the result of over-optimistic growth projections, market volatility, and a complex fund structure that made real-time monitoring difficult. They argued that the misallocation of funds was not premeditated fraud, but a series of accounting errors exacerbated by rapid expansion. In March 2020, the Dubai courts handed down a landmark verdict. Abraaj Group was found guilty of embezzlement and fraud, sentenced to 10 years in prison, and ordered to repay $2.6 billion, a figure that far exceeds any single fund's value, reflecting both the criminal and civil dimensions of the case. Several senior executives received prison terms ranging from 3 to 7 years, while the firm itself was dissolved, its assets liquidated to satisfy creditor claims. The UNDP, though deeply shaken, announced a comprehensive overhaul of its due diligence processes for external fund managers, emphasizing greater transparency and tighter financial controls. The aftermath rippled far beyond the courtroom. Investors who had placed billions in Abraaj funds faced steep losses, prompting a wave of lawsuits across multiple jurisdictions. Some sovereign wealth funds, notably Kuwait's Public Investment Authority, wrote off entire stakes, while others pursued arbitration to recover partial capital. The scandal also ignited a broader conversation about governance standards in the burgeoning private equity scene of the Gulf, leading regulators in Saudi Arabia, Qatar, and the UAE to introduce stricter licensing requirements and mandatory third-party audits for fund managers. For the philanthropic sector, the fallout was equally sobering. Foundations that had partnered with Abraaj to fund health clinics in sub-Saharan Africa and clean energy projects in South Asia were forced to suspend or cancel initiatives, leaving vulnerable communities without promised resources. In response, a coalition of NGOs and impact investment firms launched the Transparent Impact Initiative, a platform designed to provide real-time, blockchain-based tracking of charitable capital flows, aiming to prevent a repeat of the Abraaj debacle. Yet amid the wreckage, a few lessons emerged that could reshape the future of impact investing. First, the importance of independent oversight cannot be overstated. Reliance on internal controls alone proved disastrous. Second, the allure of rapid scaling must be balanced against rigorous risk management. Investors learn to ask tougher questions about a firm's capacity to handle complex, multi-jurisdictional funds. Finally, the case underscored that no entity, no matter how prestigious, should be immune from scrutiny, especially when public or charitable money is at stake. Today, the Abraaj saga stands as a cautionary tale in the annals of financial history, a stark reminder that the line between visionary entrepreneurship and reckless ambition can be razor thin. Subscribe to The Verdict for more stories like this.